Chaudhary, good morning. Thank you for joining us. Now, State Bank of India, Mr. Chaudhary, has cut interest rates on education loan, as you had indicated in your quarterly numbers. But the big thing, of course, is, and what markets are curious to understand from you, is that when is State Bank of India looking at cutting their base rates?
Let me first put it in the context, because the moment we saw the CRR cut coming, which was a very pleasant surprise, we held out an assurance that this benefit would be passed on to the customers. So when we looked at our different interest rates, in absolute terms, the educational loan interest rate was slightly on the higher side, ranging between 12 to 14%, and the most of the concentration being between 13.25 and 14. Base rate cut has other implications, because base rate will cut only when we find that there is general softening of the interest rates. And our base rate even today is the lowest among all banks, except at least among the public sector banks, and only 3 private sector banks have the same base rate at 10. So we thought that selectively that relief could be given in educational loan, and we wanted to do a substantive rate cut than a notional rate cut. So in order to do that, we have cut the rates of interest on educational loans significantly, ranging from 0.5% to 1%, and also the endeavor is to position ourselves as the most efficient lender in the market.
Mr. Chaudhary, there is a growing demand in the market for relaxation in terms of liquidity. What is your view in this? How much of shortfall for State Bank of India, or what is the current shortfall for State Bank of India, and how realistic is it to expect a CRR cut in the next policy?
I think we had anticipated tightening of the liquidity. To my mind, it largely comes from large-scale mobilization by way of tax-free bonds and infrastructure bonds, which has taken money away from the banking system. So as of now, we are not very desperate, but I think we are just about comfortable. So a CRR cut at this point is very necessary, and particularly in view of the fact that another 50,000 crore or so of government borrowings remain for this current financial year. Definitely CRR cut would be very much necessary, and we need to prepare ourselves for another liquidity tightening that happens around 15th of March due to advance tax payments.
Mr. Chaudhary, good morning. SBI beat its own expectations in terms of margins last quarter. What's your call on NIMs this time around, and do you expect the strong performance to continue?
I would not like to make a forward-looking statement, but at least the position up to January indicates that the margins have improved even further. We had begun the year with a margin guidance of 3.5, we upped it to 3.65, then to 3.75, and always our endeavor is to under-promise and over-deliver. But we are finding that the margin improvement is approximately 3 to 5 basis points every month. So that margin improvement still continues, and which we think is the strongest point in our financials.
Mr. Chaudhary, the SBI stock took a beating on the day reports of a possible KFA rescue by SBI were wrongly circulated in certain sections of the media. What are your comments on that?
Oh, that was totally a false report, because already all banks are at a particular level. And we have made it clear in the consortium meeting that only those banks where that account is standard can be expected to do further funding. And secondly, funding Kingfisher is not an end in itself. Supposing even if, for discussion's sake, further funding is made available by a group of banks, but the company has to be EBITDA positive. Today, if any company is not EBITDA positive, even if you freeze the interest on the existing stock of debt, the company keeps losing money, but it is just not viable to support this company.
So, Mr. Chaudhary, what is the way forward for Kingfisher Airlines now? Will you be looking at giving further loans to KFA? And there are some media reports which indicate that Vijay Mallya, the chairman of UB Group, is indeed looking at hooking up some external funding.
Yes, if equity comes, then the whole picture will change. So if supposing the company needs 4,000 crores and 2,000 crores equity comes in, then all the banks should again sit together and have a particular draft revival program wherein we would like to capture all the cash flows. But the precondition for all this is additional equity. Because already this company has, lost its entire net worth in accumulated losses. The leveraging levels are very high. So recapitalization of the company is the first and foremost priority.
So what is your sense of the overall asset quality for State Bank of India, excepting one or two accounts? Do you think by and large State Bank of India NPAs are manageable, problems are not there?
So this kind of aberrations or this kind of one kingfisher or something else keeps happening every quarter. So it is not in the banking business, you do not know, so to say, which wicket will fall when. But overall we are seeing a petering out or a plateauing out of the substandard migration to substandard asset slippage in the asset quality. So it has almost stabilized, and in fact in the January and February we are seeing a reversal. That some of our assets which had fallen into substandard category in fact are tracing back to standard category or reducing the quantum of default that is there.
Mr. Chaudhary, we're seeing the request for CDR rising of late. Which are the companies or sectors demanding CDR, and what is the way going forward? Do you see or rather hope this upward trajectory continues?
Companies that are requesting are which are very heavy on debt. The leveraging is 3+. And if you are looking at sectors, it is most likely the iron and steel is very prone, because there is a lot of dislocation in the raw material supplies. We are also seeing CDR requests from the textiles because of the relative low value of the competitors' currencies. They are finding it difficult to compete in the export market, and the sharp fall in the cotton prices have led to a diminution in their inventory value. And then there are of course many others, including some hotels and paper industry, so it cuts across almost all segments, and largely in the small and mid-cap space. The large caps, even if they are under stress, are able to help themselves by getting injection of fresh equity. Where the companies are challenged in terms of access to capital, that is where the CDRs are happening more and more.
Mr. Chaudhary, how has the credit growth held up in the fourth quarter, and which sectors have been the driving factors, so to speak, for the bank? And what are your projections for the credit growth going into FY13?
We were slightly surprised to see a surge in credit demand in largely the second and third week of February, and it has come largely from the petroleum marketing companies. Because why it has come is not because there is a sudden surge in demand, but so far they were financing themselves at the short end by the commercial paper market, the CP market. Because the CP market, the pricing was about 9.7, 9.8, which was cheaper than the base rate of most banks. But suddenly the CP rates have moved to 10.4 and 10.5, so the companies which took recourse to CPs are coming back to the loan market. So I think it's not so much a structural issue, but more a allocation between CP and the loan market.
Mr. Chaudhary, as of now, State Bank of India is growing at about 16% plus, and after the government capital infusion, you have enough tier 1 capital buffer. But what if credit growth picks in the second half of this year, and if State Bank of India plans to grow their credit in 20% plus, do you have enough tier 1 capital?
I think with 9% capital adequacy we can sustain 10% credit growth right up to the first half. Then as we go along we'll see, and then now the government holding would be up to 62%, so little dilution by making a QIP or a follow-on offer, both would be possible. But we'll take a call only when that situation comes, and we'll have to consult the government, and we'll leave that issue to be decided or to be taken a view on for the next financial year, that is post April-May, when we finalize our financial results for March 12.